Technology stocks took a hit today and drove major indexes in the U.S. lower. My next guest believes the Christmas rally may simply be late this year. Let's go to Adam Johnson, founder, author of Bullseye Brief. Thanks for joining us today, Adam.
Oh, great to be with you, Morel. Thanks for having me.
You say algorithms are pushing down tech stocks. Explain.
Oh, absolutely. So I'm long a lot of AI stocks right now, as I'm sure many of our viewers are. And this morning at about 10:30, all of a sudden, the NASDAQ dropped about 3/4 of a point. And when I looked to the side of my screen, what I noticed was that 8 of my, call it 10 AI names were all down instantaneously by exactly the same amount. When you see 8 different stocks that are all down, call it 7%, within 1 or 2 basis points, in other words, one's down 7.01%, another's down 6.99. When you have 8 stocks all down by exactly the same amount, that's not people making sales. That's computers making sales that are specifically shorting stocks in very specific amounts to keep those amounts that they're short in line. That's why the prices are going. It's highly controlled. And I think what's driving it is this notion that we're spending too much on AI. No, we're not. We can afford it. And number 2, that AI stocks are trading too rich. Actually, no, they're not. Nowhere near the valuations we have seen during previous bubbles. But it only takes people to start talking about that for the computer programmers to start programming for headlines that look for negative commentary, for example, on Twitter, and all of a sudden they start seeing that surge, and then the computers go out and start shorting. And the more they're able to short, the more they do short, and then all of a sudden you have a bunch of names that are down 7-8%. That's why I think it's computer driven.
Okay, so this was kicked off, of course, by sentiment. People are worried about CapEx spend into AI. They're worried about valuations, as you mentioned. Do you see this the sentiment carrying into the new year?
It'll run its course. Does it carry to the new year? Does it end next week? Here's the way I'm looking at it. If you remember about 9 or 10 months ago, everybody freaked out over China's deep seek. We thought, oh my gosh, the Chinese are going to just tear GPT to shreds. They're going to do it for free, and maybe the whole AI trade is over. And then we ultimately learned that the Chinese built DeepSeek on the back of 2,200 Nvidia chips and code that was stolen from ChatGPT. So it all came right back to the US. And once we got comfortable with that notion, we realized, oh, no, the AI trade isn't over. It's only just begun. And the AI stocks like Nvidia, or led by Nvidia at that point, went on to new highs. Well, right now we've got this freak out about spend and valuation. And I think once we get comfortable with the metrics around spend and valuation, I think the selling will have exhausted itself, and value buyers like me will continue to buy and ultimately drive these stocks higher.
Okay, so what are you buying now?
Oh, take your pick. They were all down. Applied Digital, which builds data centers. CoreWeave, which rents out AI capacity in data centers owned by Applied Digital. Sterling Infrastructure, which was down crazy, like 11% today. They build data centers in part for Applied. That stock is growing, oh gosh, 25-30% and trading at like 20 times earnings. Really? GE Vernova, which powers data centers. It's a spinoff from the old GE, where they basically take a jet engine, instead of running jet fuel through it, they run natural gas through it. And instead of creating propulsion, they just spin a turbine that ultimately generates electricity on site. So we've sold the whole question about how do we power data centers. So my point is, there's an entire ecosystem around data centers. And did you know, in those 4 names, I didn't even mention Nvidia. So there's a lot more to buy than just Nvidia.
Okay, what are you not buying these days? What do you see as stocks that you don't think have a long runway in 2026?
Yeah, fair question. Well, one of the other questions, I mentioned GE Vernova, which you're showing for viewers right there, as a way to power data centers. One of the trades that's kind of been making its way around Wall Street is the small nuclear reactors, on the assumption that, like GE Vernova, we could actually create power sources right at the data centers, right where they're needed, or for that matter, any factory. And the technology does exist. I mean, nuclear submarines use small nuclear reactors. But the problem is, it's very hard to actually commercialize these things, and it takes a long time to build, not just to get the permits, but also to build. And so if you look at the small nuclear reactor stocks, they're likely not going to generate revenues, any serious revenue, above $1 billion. They're not going to generate that kind of money for 3 to 5 years, which means they're not going to generate profits for probably 5 to 7. And guess what? I don't want to own companies that can't make money for 5 to 7 years. That just doesn't work. And you know what? I would say the quantum computing stocks are in the same boat. It's very exciting. And who knows? Maybe one day quantum computing will replace my beloved Nvidia GPU chips. But until that happens, and again, quantum computing is far from proven. Until that happens, I don't think you can own the quantum stocks. They've all come way down, as have the small nuclear reactors.
Okay, give me your big picture look for 2026 for the U.S. economy. You've got the rate cut that happened, jobs, the labor market's weaker, but you also will have the offset of the one big beautiful bill. What's your take on what's ahead for the U.S. economy next year?
There is far more to like than to fear. Just start at the top with GDP. We're growing at about 4 to 4.2%. That's very impressive. And I think it's going to accelerate. And it's going to accelerate because earnings right now are growing. They've grown double digits for the past 4 quarters. I think that Q4 will mark a 5th consecutive quarter. And profit margins are at 15 to 20-year records, about 13.2%. In spite of tariffs and inflation, I think that's the payoff, the initial payoff of AI. We still have the vast majority of people working in this country. I recognize unemployment did tick higher in the most recent data, but that's because the labor force got bigger. More people are being counted. So as long as you have people gainfully employed, making record incomes and spending record amounts, that's driving consumption. 2/3 of GDP is consumer driven. And that also is very good for businesses that will keep generating these earnings and record margins. So it's not a perfect world. There geopolitically is a lot that's uncomfortable. But if I look at just the numbers, if I look at what AI is doing for productivity, if I look at what inflation is doing, which is coming down, if I look at interest rates that are likely to go lower, I see a lot more to like than to fear.
Adam Johnson, sir, got to leave it there. Adam's founder and author of Bullseye Brief. Thanks for your time.